So, today we're going to be ending the week by talking about what the Fed rate cuts mean for our money. From savings to our investments. We're going to get into that. But before we do, don't forget to like, subscribe, hit the notification bell, and make sure to leave me a comment. Let's first recap what the Fed rate cut means. When the Federal Reserve lowers interest rates, they're making it cheaper for banks to borrow money. So this trickles throughout the economy, lowering the borrowing costs for businesses and consumers. So lower rates impact us by having a lower rate for us to get a mortgage or car loan or cheaper credit card rates. But on the other end, lower rates lower our returns on our savings as well as investments that rely on interest rate growth. So we just had a recent rate cut of 50 basis points, which means that the Fed is actively trying to stimulate the economy by encouraging spending and investments. So I'm already seeing headlines like this that they're anticipating the likelihood of another 50 basis point cut in November. So first, let's talk about how this impacts savings. I was alerted from Webull and checked on my Discover account today, and this is what I found out. And I'm sure you'll be seeing the same if you have a high yield savings account like I do. Effective as of September 24th, just a few days ago, my APY on my regular savings accounts over at Discover went from 4.2% down to 4.1%. And they have been coming down slightly over the last few months, but that was the most recent update on my APY. And then I received this letter from Webull stating that the 5% APY associated with their cash management program will be decreasing to 4.25% effective October 1st, 2024. This is all part of the Fed rate cut strategy. So we are definitely going to be earning less on our savings account, but that ties in with the goal of the rate cuts, which is to keep the economy moving. But even with the rate cuts, rates are still historically high compared to what they were a few years ago when the APYs were barely over 1%. We can see here, even with Discover coming down to 4.1%, it's still drastically higher than the 0.01% that you're going to get at local banks like Bank of America, Chase, or Wells Fargo. Now, for those of you considering a larger purchase like a home, or if you may have to finance a portion of a car, the rate cuts could be beneficial for you. Lower interest rates equal lower monthly payments on your loan. So let's take a quick look at this clip from the Today Show talking about mortgages and refinancing.
The rates fall so much slower than they go up. So zooming out, let's look at the 30-year fixed rate right now, 6.15%. So what the Fed does, it's a benchmark rate. It doesn't directly set mortgage rates, but it does have a major influence. But look at what's happened since 2021, the same time, September. Rates were 3%. The next year, they jumped to 6%, doubled. So last year in October, by the way, it was 8%. We were kissing 8%. So now at 6%, everyone was anticipating this rate cut. But Fannie Mae and Freddie Mac, the two financial institutions, are predicting that by the end of next year, we'll be down to 5.7%. That doesn't sound like amazing, but the Fed chair has said he doesn't think we're going to see 3% ever again. I would say it's so tempting to try and refinance right now, but you're absolutely right. The Fed will meet again in November after the election, and in December. They're projecting another half-point cut. So if you can wait even into early next year, they say go ahead and wait. Because here's the thing. Refinancing isn't free, right? So here's what you want to think about. Number one, would you refinance to a new rate that's 1 to 2% lower than what you're paying? Okay, maybe think about it. Refinancing costs 2 to 6% of the new loan amount. Sure, the lender's going to say, we'll roll it into your monthly payments. You don't have to pay it all up front. But you got to do the math. Look at the monthly payment and see now you're extending your loan longer. Will the savings outweigh the cost?
So as you can see, there is improvement that will be coming, but it takes time. So as she was sharing, you'll need to figure out the timing and keep your eyes on these things so that you can figure out if you need to refinance, what is going to be the best time and the right amount to make it worthwhile for you. And as interest rates come down, hopefully, as she said, to 5.7% in the upcoming year, if you are going to be looking to buy a home, we have to make sure that our credit score is on point and that we're working with a good real estate agent, because we'll probably be facing low inventory and high demand because buyers have been waiting for a chance and for some improvement when it comes to the rates. And when it comes to car loans, you have to get out there and advocate for yourself there also. You may want to take a look at other lenders outside of the ones that they're offering you at the dealership. Maybe check out your local credit union or evaluate rates from other lenders and not just feel that what they are presenting to you is the best option. Do the comparison yourself so that you are sure. Now, when it comes to credit cards, the rates might also come down a bit. But if you're not opening a new account, maybe you'll have to take the step to connect with them, call them up, try to negotiate, and see if there's any improvement that they can do if you are currently in that stage of trying to pay down credit card debt. I know I just recently got this update from Macy's saying that my credit card interest rate is going to 34.49%. I'm not anticipating an update that they decided to lower this, but we will see. My plan is to just use cards like that and pay them off immediately, whether it's a store card or a major credit card. Okay, so now let's talk a little bit about our investments. How does this affect our portfolio? A rate cut can boost the stock market in the short term as companies borrow money more cheaply and are able to expand. So, if you're investing into ETFs like VTI or SCHD, we might see a positive impact in our investments. So, investments like SCHD, which focus on dividend paying companies, may become more appealing to investors over something like bonds because the bonds are going to be impacted, offering lower yields as the rate cuts occur. So another area that may benefit is our tech and growth stocks, as lower borrowing costs can fuel innovation and expansion in these sectors. But remember, investing is a long-term game. Rate cuts are just a part of the puzzle, but we just have to make our strategy and stick to it. So as I said, the rate cuts are designed to make the economy more stable, and I'm hoping that the measures that they are taking will help to achieve that. So me personally, I'm going to continue to dollar cost average into my chosen investments that I've already done my research on and have been committed to for some time now. That's my way of just moving forward continuously in order to just weather the volatility of the market. And when it comes to savings, if you're not already taking advantage of a high yield savings account, don't feel like it's too late, that the rates are coming down. They are still, as I mentioned, drastically higher than you can get at your local bank or credit union. So if you haven't already, get that set up. And for you borrowers, keep your eyes on those rates so that you can make sure to take advantage whenever they do drop lower. Like they said, we may never see those 3% again, but I'm glad that I was able to refinance, I think, back in 2021 and also buy a home back then. I haven't bought another since, but we will see what the rates are looking like next time around. I'm glad to see some improvement from the nearly 8% that we were at last year. So leave me a comment and let me know, what is your current focus? Is it just going heavy on your investing? Do you need to focus on getting rid of that debt, buying or refinancing a home or a car, evaluating how much money you have sitting in cash now that the rates are coming down? Do you need to move more into investments? So the market has its ups and downs. We've been through this before, thinking back to 2007, 8, 9. We're going through that kind of same trend again right now. I wasn't as focused on my investing back then, but I am today, and I will make sure to have my eyes open, have my money ready, and try to take advantage of every opportunity to improve my financial outlook. So thanks for watching. Hope you had a great week, and I will see you on Sunday. Make sure to hit the notification bell to keep up with my latest videos and live streams. Thanks for watching. Okay, bye.